Good morning, ladies and gents. It's Nick at Optima PS. Thank you very much for coming back to my channel and listening to me ramble on a little bit more for you. I really do appreciate it, and I hope you get some value from what I have to say. So I've just been thinking out loud to myself again today. I have no real idea what I'm going to talk about today, or other than the word diversification. So something popped into my head when I was looking at the charts today, as I'm pretty confident you are all very well aware. The crypto world is having a bad time right now. It's a sea of red out there. In fact, the only greens we see in the last 7 days are the stable coins. So the world is in a shaky place in general. There's been one or two things that have gone on geopolitically out there that we're all aware of now. I don't need to talk about in much more detail, um, but they have rattled the markets a little bit, and so we're in a point where both the traditional finance world and the crypto world have seen a good wobble. And it really got me onto something I wanted to talk about today, which is diversifying the portfolio. Before I do that, as ever, just wanted to say to you, I am a financial advisor, but anything I say or do in this video is absolutely not financial advice. I'm not your financial advisor. Before I became anyone's financial advisor, you'd have to sign a whole bunch of paperwork and contracts and disclaimers and things like this. So up until that point, when you'd be very, very well aware that I am your financial advisor now, then assume anything I say or do here is just a guy expressing his opinion on the internet. And until I knew any of your personal details, I couldn't possibly dream of giving you any financial advice. And anything you took as financial advice would be a very bad idea, because it would be bad financial advice before I know anything about you. So in that respect, it's just me expressing a few thoughts on the internet. But I did want to say one or two things this morning, because I've seen lots and lots of tweets popping up recently. I don't know if we still call them tweets now. It's on X. Is it still a tweet? I don't know, to be honest. You tweet on Twitter. I don't know what you do on X, but whatever it is, people posting on X. And basically, a lot of people, I'm in the XRP community predominantly. I'm in lots of cryptocurrencies, but I tend to find that my audience base and my own personal the people I follow as their audience tends to be XRP orientated before most, which is only natural because that's my biggest holding by quite a long way. And I imagine most people that listen to me, or most people in my community, are similar style people. They have a larger holding in XRP than anything else. There's a lot of us out there, and it's a very frustrated community right now. And I see a lot of posts from people. I'm not going to highlight them on here, but a lot of posts from people going, I put all my money into XRP and it's now down. I bought at $1 and it's 50 cents and it's been down for years and I can't get my money out and life's terrible. And I blame Brad and I blame David Schwartz and I blame everybody in the world except for myself. And I sympathize, I really do. But in the same respect, I wanted to do this video today to talk about, this is why, this space is very much a community of people who, we don't need financial advisors. That's for the old guys. That's for the grandpas. That's for the baby boomers. We do this ourselves. We're smart. We're savvy. You're all those things. I have no problem with that whatsoever. But there's some things that cross over from the traditional finance space that just make sense to everybody. No matter who you are in the world, whether you're a guy with $1 billion in the bank already, or whether you're a guy with 500 books to your name, there are certain things that just make sense. And the traditional finance space, we teach it because we all have to be qualified and regulated in a way that means we ought to teach it. And it's something it's a lesson worth being taught. So I just wanted to come on to this. I mean, this is just a quick glance at the crypto market right now. I mean, here's a great example of why diversification is important. Everything is down at the moment, with the exception of stablecoins. And I bet if I ask most of you people out there, like me, very few of you will own stablecoins. I don't own stablecoins. I've used stablecoins in the past. When I've seen that some of my coins are high in value, I've moved into stablecoins to anticipate a drop to then buy back in. Definitely not day trading. I don't day trade in crypto. It's too volatile. I'm not good enough at it. I do swing trades from time to time, but there are certain times where it just makes perfect sense. Back when Bitcoin hit its all-time high, I think I got out of Bitcoin at $63,000, as opposed to the actual all-time high. But I looked at it. I knew we were there or thereabouts. I sold my Bitcoin. I moved into Tether. I let the world around me tumble. and then I bought back into Bitcoin again. I bought a few other coins this next time round as well. But it's something I use, but I don't hold stable coins. And if you were a person that needed your money today, and you also didn't hold stable coins, well, then you're taking out at a loss from where we were a week ago on almost everything in the market. If you had a small amount in a stable coin, you could have withdrawn from your stable coins. It's just a simple concept, you know. Nobody wants to put every last penny into stable coins and never make any profit, but sometimes having a little bit there makes sense. But then we're talking about the greater term when we come to diversification now. So I personally, my crypto portfolio is quite highly strung into XRP. I'm over leveraged in XRP if I'm really honest, because it's the one I believe in the most. Going against my greater financial advice that I would normally give to people, I'm over leveraged and overexposed to XRP when it comes to my crypto holdings. But my crypto holdings only make up about 10% of my my gross, my global, my overall portfolio, however you want to look at it. So even though a large portion of my crypto holdings is XRP, it's not a large portion of my overall wealth. So if something terrible happened to me today, I mean, as it happens, something looks like it might happen in the next couple of weeks. That means I'm going to have less income this year than I thought I was going to have. I won't get into that in a great detail. It's not my fault, by the way. I blame it on the Mideast. It's something that happened over there that has changed the way one of my investments is going to work this year. And so I'm going to lose about $50,000 that I thought, no, I'm not going to lose the money. I'm not going to see it mature until another 12 months from now because of the actions in the Mideast. And that is perfectly fine by me because it's only one or two of the small holdings, but it's about $50,000 difference to what I thought was going to be my income. So if I was in a position where I needed to get cash out of somewhere right now, I'd hate to have to take it out of my Bitcoin or my Ethereum or my XRP or whichever coin it is that's down. Most of my crypto portfolio is still actually up. So this is a purely hypothetical situation. But let's imagine I bought XRP at the all-time high last time. You know, I bought it at $3. And today I desperately need my XRP to be released because I'm losing money from my other income sources this year because of what's going on in the Mideast. Then I'm in a very, very difficult position because I have to go, well, I bought for $3. It's now worth less than 50 cents. So I'm literally going to be taking my investment out at 15% of the value it cost me. That's a terrible position to be in. However, I diversify. I've got investments in the S&P 500. I've got investments in the NASDAQ, individual stocks, and in the actual indices as well. Guess where I would take my money from if I needed to access money? I don't need to access any money. I've got other cash I can access anyway. But if I did need to access my money, I wouldn't be taking it from XRP that I bought at $3 and it's now down at $15. I would be taking it from something that's a profitable investment because I only ever like to crystallize a profit, not a loss. It's a simple fact of any investment in the world. If you sell higher than you bought, you're a happy man. There's reasons why, you know, even my XRP is up. I would not sell my XRP before I sold my NASDAQ holdings for the simple reason that I believe the XRP has more growth to come than what I have in the NASDAQ index, for example. So the fact that I've diversified means I have the ability to take from wherever I choose, and I'm obviously going to choose the one that makes the most financial sense. And then we just move on to a couple of things. So these are a couple of visualizations that I think are really useful. This one's a little bit old now. There's a couple of stocks on here that would be here today if it was an up-to-date one, but it's more about the message this portrays as opposed to the actual factual information. But this is talking about if you had $100, what would you have today based on a total return from December the 31st, 2009 to December the 5th, 2019. The reason I've used an older one, by the way, is there's another lesson in that as well. So the most profitable investment you could have chosen between these periods would have been Netflix. That's simple fact. So Netflix is classed as a communication service. I know we think of it more as entertainment for TV, but it is technically communication services as how the stock is classified. Next down we have Market Access, which is financials. A Biomed, which is a healthcare company. I actually don't know that company, to be honest with you. I don't know every company out there. TransDigm, industrials. Broadcom, IT. Align, which is healthcare. United Rentals, which is classed as industrials, even though you might think it's more along the real estate route, but most of what they do is a lot of lettings and things like that. Regeneration, which is classed, I think, as healthcare. Ultra, which is again probably consumer discretionary. Amazon, again, is classed as consumer discretionary. There's a big difference between consumer discretionary and consumer staples out there. Most people struggle to identify the difference, but what I view it as very, very simply is discretionary is exactly that. It's what you choose to buy as opposed to what you need to buy. So staples are things like food, general expenses. I now class things like your mobile phone, as part of a staple, because the simple fact of the matter is we all need one to operate now, your internet provider, that kind of thing. Discretionary is things you choose. So you could choose the latest iPhone as opposed to just a functioning mobile phone for $20. It's that's the key difference there. Then you've got real estate, you've got back to staples again, you've got IT, you've got discretionary IT. The point here is, even going back 10 years ago, there was a huge discretionary difference between the various stocks that were the best. So if you'd come out there and said, I'm only buying stocks that do online streaming, you'd have done well because you'd have bought Netflix and some of the competitors, but some of the other ones didn't make it into these top stocks. If you'd spread your net further, you'd have done better. We move on to this chart, which is one of my favorite tools in the investment world when it comes to just sharing some knowledge and how things work. This is a site called Novel Investor, and this is the S&P 500 sectors that have performed the best over the last 10 years, as it would be. Well, it's 13 years there, isn't it, almost? But the difference is here, you've got consumer discretionary, you've got consumer staples, you've got energy, you've got financials, you've got healthcare, you've got industrials, you've got information technology, you've got materials index, real estate index, communication services index, utilities index, and then just the S&P 500 index as an overall. And so what's really interesting on this is every year: 2009, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 through to 23. The top performers in each year and the rankings in each year, that's a multicultural tapestry. Let's look at IT. Most people here would assume IT would be the top performer most years of the last 15 years, right? IT performed top once, twice, 3, 4, 5 times. So it's more commonly at the top. It's more prominently up there as the top performer, but it's not there every year. Real estate has been top twice, second once, third, fourth, fifth. Real estate has not been a top performer over the each and every year, but again, it's consistently performed. Utilities only top once, but second 3 times. Financials only top once. That's very telling. If you'd done this going back to maybe 25 years ago, financials would have been top an awful lot more. But again, with financials, it's ordinarily around the top quarter. Then we go back to consumer discretionary, top twice, second 1, 2, 3, third 1, 2, 3, 4. You move on. Real estate again was top in 2014. What's here? Oh, energy. So energy is another one, right? So all the the talk of energy with the oil prices and things like this. So the last couple of years, perhaps 21, 22, it was up there. No surprise that IT was up there in 23. Realistically speaking, we all know what the IT stocks have done. The AI section of IT, I class that as the same, really. But energy is up there. But then in other years, energy's been right down near the bottom. So it shows you how inconsistent energy is. You go through again, healthcare only been top once, but then consistently in and around, So what this shows you is there is no rhyme or reason to which investment is going to do better in which year. There just isn't. What's interesting is here, when you look at the S&P, that doesn't highlight overly well because the S&P is almost the same color as the back screen, but it's never the bottom, it's never the top, because it's an index. That's one of the reasons I feel an index will be a very, very good solution to the cryptocurrency world. I think as soon as the next ETF is launched, which I suspect will be Ethereum, I don't think they're going to backtrack on Ethereum. I think they'll sign off Ethereum before they sign off XRP because they've just got a bee in their bonnet with XRP. But I think as soon as the next ETF is approved, the one after that will be an index-based ETF as opposed to a straightforward one particular coin. And this is why. If you look at this, the S&P, it's the highest it ever was fourth. The lowest it ever was third from the bottom. If you just bought the S&P 500 index every day or every year, however you want to do it without fail, since it launched in 1957, you'd make about 9.5, almost now with increasing years, 10% a year. It's a very, very safe, steady form of investment. That's why I like the idea of a cryptocurrency index ETF. In the same respect, you'll never be top. You'd never have made the most money in any single year. You'd have also never made the worst in any single year. So it's a nice steady eddy for people. The whole point of this is just to show you exactly how diversification works. There's not one sector that's ever been the top. Yes, in cryptocurrency, slightly different. Bitcoin is ordinarily the top when it comes to market cap, but not when it comes to performance. When it comes to performance, your cryptocurrencies have various years. This year we've seen some meme coins do incredibly well. We've seen most coins do okay. XRP is the one dragging its feet. But again, you look at XRP, and the simple fact of the matter is it's done 50% in the last, 12 months, give or take. In this world, that would be top. Cryptocurrencies would be, if they were a sector here, they would be top most years for the last 10 years. But again, in the years they weren't, they'd be way down the bottom. So it all depends on how volatile you want your portfolio to be. I'm not saying don't keep buying cryptocurrencies. I'm saying if you were in a cryptocurrency year that, everything was down, 2021, 22, everything came tumbling down after that all-time high when our friend Mr. Bankman-Fried went and screwed most of the industry. Everything came tumbling down. That year, if you needed money, you would not have been a happy person withdrawing from your crypto. Many people sold, many people panicked, many people got out quick. But if you were someone who understood the markets and how they work, but life had worked against you, you'd lost your job, you had medical bills, somebody needed some help, whatever the reason might be, it would have been a dreadful year to withdraw. And this is why I go back to investment in general, diversification. The traditional finance world teaches us there's always a reason. Look at these different years, different things, different sectors. There's always a reason to diversify. I hope that all makes sense. It doesn't have to be your whole portfolio. It could be 10% in traditional finance that you've got easy access to, an ETF, just in case everything goes wrong, you need to get your hands on $5 grand. You might crash your car, you need a new car. You might need an operation. You might need to help somebody else who's been made redundant. But there's a million reasons why. Always have something to hand, because crypto will see negative years again in the future. No two ways about it. There will be days when I look at my XRP portfolio and I go, oh my God, I need money out and I'm 50% down. Especially from the end of this bull when I expect XRP to hit a nice price, I won't cash it all in. Then a year later, I'm going, I could have cashed in at $50, now it's 25. I could have cashed in at $5, now it's $2.50. I could have cashed in at $5, now it's $1. I'm only going to get $1 back for my XRP. Still would be a profit for me as it happens, but it's not the point. Psychologically, you don't ever want to take something out today that you could have got for far more money a year ago, 6 months ago, a week ago. Diversifying your portfolio means you have options to always withdraw whatever is high. Bonds are doing quite well right now. Why? Because there's a lot more uncertainty in the market, but bonds are down compared to everything else in the year. But again, there's always something you can take out of that you need to withdraw from at whatever time it is, if you've covered enough angles. I hope that all makes sense. Hope I didn't bore you all to death. I do like this, by the way. I would take a quick look. It's called Novel Investor. They do this each and every year. They'll sort of update this for you, and it's a really nice tool to take a look at. But listen, guys, I'm going to leave that with you. It's 20 minutes now. I really hope this brought some value to you. If you do like what I had to say today, please like and share my video. It works wonders with the algorithm on YouTube. It works wonders for my own personal information. I know that people are actually enjoying what I have to say. And if you disagree or you want to ask me any questions, drop in the comments box. That'll be wonderful. In the meantime, thanks very much for hearing me out. It's been great having you here again. So I'm really grateful for your time, and we'll speak again soon. All the best, Nick.